Hey guys, and welcome to the 2-Minute Money Manager. I'm your host, Stacey Johnson, and this answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Now, today's question comes to us from Jane. Here's what she says. I've made a lot of money in stocks over the last several years, and now I'm afraid of losing it if the market drops. Should I sell? Okay, Jane, let's discuss. Now, me personally, while I'm never going to get out of the stock market completely, I have started taking some profits lately, taking some money off the table. Here are 5 reasons why. Number 1, trees don't grow to the sky. In 2009, when the Dow was about 7,000, I bought a bunch of stocks, not because I'm a genius, but because having lived through several recessions, I've learned that the time to buy is when everyone's freaking out. And they were definitely freaking out in 2009. As I speak, the Dow's at 27,000, nearly 4 times higher than it was back in 2009. Now, I haven't quadrupled the money I put into stocks back then, but I have done well. Stocks today, though, are no longer cheap. The average stock price earnings ratio over the last 100 years, about 15, meaning stocks are typically priced at about 15 times their earnings per share. That ratio now, though, is 22. It's been worse, but however you slice it, stocks today are more overpriced than underpriced. In addition, we're now in the longest economic expansion the nation's ever seen. Now, while it's certainly possible for the party to continue, we're definitely closer to the end than the beginning. Reason number 2 I'm taking some money off the table is I'm overweight. I actually could stand to lose a few pounds, but what I mean when I say overweight is a weighting of stocks in my overall investment mix. Because stocks have grown so much over the last decade, I now have a big percentage of my long-term savings there. So in other words, my mix is out of whack. Now's a good time for me and you to look at your investments and at least consider rebalancing so you don't have too much in stocks. Wait too long and the market might just do it for you. Number 3, I'm not getting any younger. I preach a simple rule of thumb, guys. This is how I decide on the percentage of long-term savings that belong in stocks. It should be the inverse of your age. In other words, if you're 40, you should have about 60% in stocks. If you're 63, like I am, you'd have 37% in stocks. Now, when I bought stocks back in 2009, my age suggests that I should have 47% in stocks. Now that's lower, so I should adjust. Now, to be honest, I probably am not going to go to 37%. That's okay. It's just a rule of thumb. Still, I've made a lot over the last 10 years, and I don't want to give it all back during the next recession. Reason number 4 I'm selling, Voodoo economics. I'm no professor, but I know Voodoo economics when I see it. Case in point, with the economy at nearly full employment and the stock market at record highs, the Federal Reserve is lowering interest rates. Historically, the Fed uses rate cuts to stimulate a weak economy, not goose a healthy one. When the good times roll, the Fed traditionally normalizes rates, meaning it raises them back to where they were, both to keep the economy from overheating and so they'll have ammunition to stimulate the economy by lowering rates when times get tough. At least that's the way it used to be. These days, we have a president who's taking credit for the best economy the world has ever known, while in the same breath berating the Fed for not lowering rates. That's weird. It doesn't make any sense, and it makes me uncomfortable. Bottom line, if the Fed is lowering rates because they see a potential recession ahead, that's scary. If they're lowering them when they shouldn't because of Trump's bullying, that's also scary. And the final reason, number 5, trade wars aren't good or easy to win. You know, in March of 2018, the president famously tweeted, "Trade wars are good and easy to win." False. By just about anyone's estimation, trade wars have a negative effect on the global economy. The president has also suggested multiple times that China is paying the tariffs imposed on $250 billion worth of Chinese imports, while America reaps the benefits. This is also false. A tariff is a tax. Think of it like you would a sales tax, except for this one's up to 25%. When an American company buys Chinese products affected by the tariffs, they're paying that tax, which obviously increases their cost. They then have 2 choices: eat the additional cost and make less money, or pass that cost along to their customers and as a result, sell fewer units. Neither one of these are good for stocks. Of course, the trade war could end tomorrow with the stroke of a pen, which would certainly send stocks higher. While that's a possibility, however, imagine for a moment you're China. You know your antagonist is up for election next year. Would you roll over now or drag your feet and wait to see if he gets replaced. The bottom line here, timing the market is a fool's game, not something I'd ever advise. That being said, however, now and then circumstances dictate taking decisive action. One of those times for me was in March of 2009 when I jumped into the market with both feet. Another is now when I'm taking one foot out. I hope that answers your question, Jane. And that's it for today. I'm Stacey Johnson. Look me up anytime at moneytalksnews.com.